Hi, and welcome to my channel, where I will be sharing my passion for personal finance and investing. I love researching income-generating stocks and ETFs, and on this channel, I will document my journey to building wealth and share everything I have learned along the way. Please remember this is not investment advice, and all investments carry risk. Always do your own research before making any financial decisions. Today, we're diving into a company most of us know and love, Starbucks. I will be talking about their dividend, how it's grown over time, and whether it's sustainable going forward. Starbucks is one of my favorite dividend growers. I like the fact the company has an incredibly simple business model, and it is easy to understand how they make money. They also have a loyal customer base of people who are regularly going to Starbucks for their coffee. The company has a strong multinational presence, and I personally believe it will remain a consumer staple for the years to come. However, Starbucks is a mature company, and their share price has seen some decline in recent years, dropping 16% in the last year, and showing a 12% decline over the past 5 years, as the company's share price has been down since its all-time high in 2021. Starbucks is currently trading at a P/E of 79. This indicates a high valuation compared to its 10-year average of roughly 38 to 39, reflecting market expectations for future growth, despite recent earnings pressure. Let's now analyze the company's dividend in detail by looking at 3 key metrics: current dividend yield, dividend growth rate, and payout ratio. First, let's look at the dividend yield, which indicates how much a company pays out in dividends each year relative to its stock price. This is calculated by dividing the annual dividend per share by the stock price. Their most recent annual payout was around $2.48 per share, and the dividends are paid quarterly. Next, the dividend growth reflects the company's ability to increase dividends over time, which is one of the signs of a good financial health of a company. Ideally, we want to see a consistent track record of dividend increases, at least in line with inflation. It is my favorite metric. A dividend growth rewards holding shares over time. Think of it as receiving a salary increase every year just by being a shareholder and holding the stock in your portfolio. Starbucks have been paying dividends for years and has raised its dividend for 15 consecutive years. This steady increase is what gets many income investors excited. Historical dividend growth rates have been strong, with a 5-year average growth rate of 6.2%. That's a compelling storyline. Payouts rising even when broader markets struggle. Lastly, the payout ratio shows what percentage of earnings are being paid out as dividends. Payout ratio is calculated by dividing the dividend per share by the earnings per share, EPS. A lower number is generally better, as it indicates that the company retains more earnings for growth. When the payout ratio is too high, it could indicate the dividend may not be safe or might not have room to grow over the upcoming years. The question, therefore, is, are these dividends sustainable? Most recently, Starbucks' payout ratio has been reported above 203%. That means the dividend is more than twice the company's reported earnings. That's a major red flag in the long term. However, when using the forward earnings per share, the payout ratio looks much healthier, with just 84% of projected earnings over the next 12 months to be paid out as dividends, based on consolidated analyst estimates. Therefore, while Starbucks might be paying out more than it earns right now, it is possible the situation will improve with projected earnings increasing. Moreover, during a recent investor day, Starbucks have announced their plans for global expansion. These include opening thousands of new stores globally in the coming years, with more than 2,000 locations outside of the U.S. in fiscal year 2028, as their international business annual revenue is growing more quickly. Starbucks also want to double down on their locations being a third space where people can hang out and work. So here's my take. Right now, Starbucks can pay their dividend, and analysts generally expect it to remain safe as earnings recover. But the high payout ratios and pressure on cash flow in the short term are worth keeping an eye on. And if you want to be extra careful, perhaps there are other safer dividend stocks to consider instead. While I personally believe in the long-term reliability of Starbucks based on their strong brand, expansion plans, and a long history of returning capital to shareholders, as dividend investors, we must ask if the company's future earnings will continue to pay their shareholders a growing, sustainable cash flow. Thank you for watching until the end. I hope you have enjoyed the video. If you have any questions, please put them in the comments section and I will do my best to answer them. See you next time.